One dividend ETF is crushing the market by over 11% this year, while its popular rival is actually losing money. But here's the twist. The winner isn't the one most investors would expect. In fact, if I told you 6 months ago that a tech-heavy dividend fund would be obliterating the market's favorite defensive dividend play, you probably would have laughed. But that's exactly what's happening in 2025, and it's rewriting everything we thought we knew about dividend investing. Let me introduce you to the reigning champion of dividend ETFs, the Schwab U.S. Dividend Equity ETF, ticker SCHD. This is the fund that income investors have worshipped for over a decade. With $71.4 billion in assets under management and a 14-year track record dating back to 2011, SCHD has been the gold standard of dividend investing. It's built like a fortress, loaded with defensive sectors like consumer staples at 19.6%, energy at 19.2%, and offering investors a juicy 3.83% dividend yield. With an expense ratio of just 0.06%, it's been the safe, reliable choice that financial advisors recommend to their most conservative clients. This is the fund that's supposed to protect you when markets get ugly. But then there's the challenger, a fund most people have never heard of, the Fidelity High Dividend ETF. Ticker FDVV, launched in September 2016 with a completely different philosophy. Instead of playing defense, FDVV decided to ask a radical question. What if the best dividend stocks of the future aren't the same tired old utilities and consumer staples that have dominated dividend portfolios for decades? What if companies like Nvidia, Microsoft, and Apple, the tech giants driving our economy, could also be incredible dividend plays? With only $6.2 billion in assets, FDVV is still the David to SCHD's Goliath. But sometimes David wins. And boy, has David been winning in 2025. While SCHD investors have watched their supposedly safe choice lose 1.16% this year, FDVV holders have been celebrating an 11.17% gain. That's a 12.33 percentage point gap in performance, the kind of difference that separates retirement dreams from retirement nightmares. But this isn't just a one-year fluke. Over the past 3 years, FDVV has delivered approximately 16.3% annualized returns compared to SCHD's 7.4%. Even over 5 years, FDVV's 18.1% annualized return crushes SCHD's 11.72%. So, what's driving this dramatic reversal of fortune? It all comes down to a fundamental shift in how we think about dividend-paying companies. SCHD's strategy is beautifully old school. It tracks the Dow Jones U.S. Dividend 100 Index, which requires companies to have paid dividends for at least 10 consecutive years. It's focused on stability, predictability, and defense. The fund's largest holdings tell the story. Chevron at 4.39%, Cisco at 4.33%, PepsiCo at 4.28%, ConocoPhillips at 4.25%, and Altria at 4.21%. These are the companies your grandfather would recognize. Steady, mature businesses that have been paying dividends since before the internet existed. FDVV took a completely different approach. Instead of just looking backward at dividend history, it looks forward at dividend growth potential. The fund tracks the Fidelity High Dividend Index, which weights companies based on current dividend yield at 70%, but also factors in payout ratio at 15%, and critically, dividend growth at 15%. This methodology led FDVV to make some controversial bets that are paying off big time in 2025. The fund's largest holding? Nvidia at 6.68%. A company that's not exactly known for dividend investing, but has been growing its dividend alongside its explosive growth in AI. Microsoft comes in second at 5.92%, followed by Apple at 4.8%, Broadcom at 2.74%, and JP Morgan at 2.7%. The sector allocation tells the whole story of this battle between old and new. Since SCHD does have 8.6% in tech, FDVV has 25.6% of its portfolio in information technology. SCHD's biggest sector bet is energy at 19.2%, a sector that's been under pressure as the world transitions toward renewable energy and electric vehicles. Meanwhile, FDVV has only 9.3% in energy, but balances growth with stability through 11.1% in healthcare and 14.2% in financials. But here's where the story gets really interesting. This isn't just about picking winners and losers, it's about understanding what kind of dividend investor you are in 2025. SCHD still offers something FDVV can't match, a higher current yield of 3.83% compared to FDVV's 3.07%. If you need income today and you need it to be predictable, SCHD's approach makes sense. The fund's focus on consumer staples, utilities, and established energy companies provides recession-resistant income that tends to hold up even when markets crash. FDVV, on the other hand, is making a bet on the future of dividend growth. While its current yield is lower, the fund has delivered approximately 8% annual dividend growth over the past 5 years, nearly matching SCHD's 8.4%. But here's the key difference. FDVV's dividend growth is coming from companies that are still in their growth phase, while SCHD's dividend growth is coming from mature companies that might be running out of room to grow. The risk profiles tell another crucial part of this story. FDVV's 3-year beta of 0.97 and standard deviation of 18.7% reveal a fund that moves with the market and experiences higher volatility. SCHD's beta of 0.88 and standard deviation of 15.1% show its defensive characteristics. But here's what's fascinating. Despite FDVV's higher volatility, its Sharpe ratio of 1.08 absolutely demolishes SCHD's 0.29, meaning FDVV has delivered much better risk-adjusted returns. The maximum drawdown numbers are sobering, though. FDVV has experienced a maximum historical drawdown of negative 40.25% compared to SCHD's negative 33.37%. This means that when markets panic, FDVV investors feel more pain, but they've also been rewarded with much higher returns during good times. So what's driving FDVV's dominance in 2025? It's a perfect storm of market conditions that favor growth-oriented dividend strategies. With 10-year Treasury yields hovering around 4.2%, investors are demanding more from dividend-paying stocks than just yield. They want growth too. The artificial intelligence boom has created massive cash flows for technology companies, many of which are now mature enough to return significant capital to shareholders through dividends and buybacks. Meanwhile, SCHD's heavy weighting in energy has been a drag, as oil prices remain volatile and the long-term transition away from fossil fuels continues. But let's be honest about the trade-offs. FDVV's expense ratio of 0.16% is nearly 3 times higher than SCHD's rock-bottom 0.06%. Over decades, that difference in fees can add up to tens of thousands of dollars in lost returns. SCHD also has the advantage of scale and liquidity with its massive $71 billion asset base compared to FDVV's $6 billion. When markets get choppy, liquidity matters. There's also the track record factor. SCHD has weathered multiple market cycles since 2011, including the COVID crash, the 2018 volatility, and various other market disruptions. FDVV launched in 2016, so it's only been tested through one major crisis. We don't know how FDVV's tech-heavy approach will perform during a prolonged bear market or a technology sector correction. The international exposure adds another layer to consider. FDVV includes approximately 10% exposure to developed international markets, providing some geographic diversification that SCHD lacks with its purely U.S. focus. In a world where supply chains are global and technology companies derive significant revenue from international markets, this diversification could be valuable. So who should choose which fund? If you're the type of investor who believes we're living through a technological revolution that will continue to create massive value and that the companies driving artificial intelligence, cloud computing, and digital transformation will be the dividend aristocrats of tomorrow, then FDVV's approach makes sense. You're willing to accept higher volatility and higher fees in exchange for exposure to dividend growth from tomorrow's blue-chip companies. But if you're someone who prioritizes sleep-at-night money, who needs income today rather than growth tomorrow, and who believes that tried-and-true defensive sectors will eventually come back into favor, then SCHD remains compelling. You're getting proven dividend sustainability, lower costs, and a defensive posture that has historically protected capital during market downturns. The fascinating thing about 2025 is that we're witnessing the evolution of dividend investing in real time. For decades, dividend investing meant buying yesterday's growth companies, the utilities, consumer staples, and industrial firms that had matured past their growth phase and were returning cash to shareholders. But FDVV represents a new paradigm, buying today's growth companies that are mature enough to pay dividends, but still young enough to grow those dividends at impressive rates. The numbers suggest this new approach is working. FDVV's outperformance isn't just about lucky stock picking. It's about recognizing that the nature of dividend-paying companies has fundamentally changed. Companies like Microsoft and Apple generate so much free cash flow that they can fund massive research and development, pursue acquisitions, and still return billions to shareholders through dividends and buybacks. Looking ahead, the big question is whether FDVV's tech-heavy approach can maintain its advantage if we see a rotation away from growth and technology stocks. History suggests that market leadership rotates over time, and the defensive sectors that SCHD favors could come back into favor during the next recession or market correction. But it's also possible that we're seeing a permanent shift in the dividend landscape, where technology companies become the new dividend aristocrats. The interest rate environment will be crucial to watch. If rates continue to rise, both dividend ETFs could face pressure, as investors can get attractive yields from risk-free treasury bonds. But if rates stabilize or decline, dividend growth strategies like FDVVs could become even more attractive relative to static bond yields. For most investors, the answer probably isn't choosing one or the other exclusively. FDVV and SCHD represent different aspects of a complete dividend strategy. Growth versus stability, innovation versus tradition, higher risk and higher reward versus lower risk and steadier income. A portfolio that includes both could capture the best of both approaches while managing the weaknesses of each. But here's what this battle really represents. It's the story of how markets evolve and how smart money adapts. The investors who recognized early that technology companies could be incredible dividend plays have been rewarded handsomely. The investors who stuck with traditional defensive dividend strategies have been left behind, at least for now. The year 2025 has been a wake-up call for dividend investors. It's shown us that the companies creating the most value in our economy today aren't necessarily the same companies that created the most value 20 or 30 years ago. And if you want your dividend portfolio to reflect where the economy is going rather than where it's been, you might need to embrace some of the volatility and uncertainty that comes with investing in the future rather than the past. So, which team are you on? Team innovation or team tradition? Are you willing to accept higher volatility and higher fees for the chance to own dividend-paying stakes in the companies that are reshaping our world? Or do you prefer the comfort and predictability of tried-and-true defensive sectors that have weathered decades of market cycles? Your answer to that question says a lot about what kind of investor you are and where you think the markets are heading next. The choice is yours, but make no mistake, the dividend investing landscape has changed forever, and 2025 might just be the year we look back on as the turning point. All right, dividend investors, your turn. Smash that like button, tell me in the comments which side you're on, and subscribe so you don't miss the next ETF battle. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.